Hello, welcome to this presentation of Santos' 2023 half-year results. I'd like to start by acknowledging the traditional lands of the Kaurna people of the Adelaide Plains from where I am speaking today. I pay my respects to their elders past, present and emerging. I'd also acknowledge and recognise the support of traditional owners and First Nations people everywhere Santos operates, including in Papua New Guinea, Timor-Leste and Alaska. I'm pleased to present yet another set of financial results that demonstrate the success of our disciplined operating model. Santos continues to generate strong cash flow despite the challenging operating environment. I will now provide an overview of the half-year financial results for 2023 before handing over to Chief Financial Officer Anthea McKinnell to discuss them in more detail. We have now fully integrated our business following the merger with Oil Search, and the benefits of our diversified asset base and disciplined operating model are reflected in the first half results. Before we start, I draw your attention to the usual disclaimer. Sales revenue of $3 billion for the first half generated EBITDAX of $2.1 billion. Free cash flow from operations of $1.1 billion and underlying profit of $800 million. The board has determined to pay a dividend for the half of $283 million or 8.7 cents per share unfranked. We are pleased to continue to deliver strong cash returns to our shareholders. Our journey to become Australia's safest operator continues. Always safe is a core value at Santos. Our expectation is that every day, everyone who works at Santos is focused on keeping themselves and their workmates safe and going home healthy. Personal safety performance improved in the first half, and pleasingly, loss of containment incidents continue to reduce. In the second half of 2023, we are focused on implementing programs to improve contractor safety performance, which has emerged as a key watch point. Our performance on reducing spills has continued to improve, and we are world-class relative to the International Association of Oil and Gas Producers' global average benchmark. However, regrettably, there were some spills across our operations, and we continue to learn from these events and improve our practices in this regard. I remain focused on ensuring that we learn from these events and drive for ever safer workplaces and fewer safety and environmental incidents. Process safety performance is critical, and we will continue to focus on driving incidents down. It's been a busy first half for all of us at Santos as we execute our strategy and seek to deliver long-term value for shareholders. At GLNG, the work we have done at Arcadia on horizontal drilling is now expected to deliver well productivity at a rate 15 times higher than vertical wells have historically produced. In the Cooper Basin, we are on track to drill more than 100 wells this year as we get back to pre-COVID activity levels and chase production. In PNG, Angore continues to progress and we expect first gas in 2024. Reliability across our operated assets in PNG continues to improve post-merger, increasing from 83% to 96%, delivering higher production. In Western Australia, we successfully commenced production from Spartan to supply gas to WA domestic market. Production from West Australia in the first half has been impacted by planned and unplanned maintenance activities, and we expect stronger production in the second half. And finally, in Northern Australia, we are expecting at least one more LNG cargo from Bayu-Undan as the team optimise well performance and exceed our forecasts. We continue to operate our upstream assets in a disciplined way to extract the most value from our diversified portfolio. Our Santos Energy Solutions business continues to expand its project pipeline and is delivering on a suite of projects. We continue to develop our 3-hub CCS strategy across our operating footprint in Australia and Timor-Leste. The Moomba CCS project was 70% complete at the end of June and expect to begin injecting carbon dioxide in the first half of 2024. Moomba will be one of the largest and lowest cost CCS projects in the world and will be the proof point for the role carbon capture and storage will and must play for Santos, for Australia, and for our customers here and in Asia. In Northern Australia, we have signed MOUs for storage of CO2 in the Bayu-Undan CCS project in excess of the expected 10 million tonnes per annum capacity. And in early August, we signed an MOU with Timor Gap, Timor-Leste's national oil company, to explore partnership opportunities in Bayu-Undan CCS. Also, in early August, the Australian Parliament passed legislation to implement the London Protocol requirements, clearing the way for bilateral negotiations between Australia and Timor-Leste to enable cross-border transport of carbon dioxide for Bayu-Undan CCS. In addition, the legislation clears the way for discussions with customer countries in Asia who are looking at CCS in Australia and Timor-Leste to help them decarbonise their energy-consuming economies. And in WA, we are in advanced discussions with third-party customers for our CCS hub there. These initiatives are a great example of the progress we are making, not only on helping decarbonise our own business and those of our customers, but also the value-generating opportunity we are creating for shareholders with our Santos Energy Solutions business. We have also progressed other carbon solution opportunities, including executing agreements with Alaskan landowners to support the generation of nature-based carbon credits for our Pikka project. A number of other nature-based carbon credit generating projects are in the pipeline. As previously mentioned, our Moomba CCS project is 70% complete at the 30th of June. Consistent with construction cost increases across the economy, we have seen some increase in costs associated with the project and now expect the total cost to be around $220 million to deliver first CO2 injection in 2024. The Barossa project was 60% complete at the end of June, and we successfully submitted the revised drilling completions environmental plan to the regulator, NOPSEMA, in July. We continue to consult with traditional owners and other relevant persons regarding how the environmental impacts of the project will be managed. We are making excellent progress on the FPSO, with the hull successfully floated at the shipyard. Santos remains focused on meeting the acceptance requirements for the environmental plan so as to enable drilling before the end of the year, keeping us on track for first gas production in 2025. At our Pikka project in Alaska, we were pleased to complete drilling of the first well this year and will remain on track for first production in 2026. Pikka is a Tier 1 project. We have a highly capable team in place supporting stakeholders and partners, including our Indigenous communities, and we are operating in a supportive and low sovereign risk jurisdiction with world-class environmental regulations, including for carbon emissions. Low carbon oil projects like Pikka Phase 1 are critical for global and United States energy security and to balance geopolitical tensions through diversification of supply sources. Cash from operations is allocated under our capital management framework to sustain our business, backfill production, invest in the energy transition, and deliver returns to our shareholders. The size and timing of shareholder returns and the delivery of returns via dividends and/or buybacks are determined by reference to a number of factors, including operational performance, market conditions, timing of major growth capex, and the recycling of capital from portfolio optimization. Our overriding concern is to maintain financial discipline throughout the cycle. For the first half of 2023, the board has decided to declare an interim cash dividend of 8.7 cents per share unfranked, 14% higher than the corresponding prior half. In July 2023, we completed the on-market buyback announced last year. The board will consider the most effective way of delivering further returns to shareholders at our full year results in February 2024. I wanted to say a few words on our view of the market for the products that we produce and that the world needs. Global LNG demand continues to grow, and forecasts show that a significant number of LNG projects will need to be sanctioned to fill the widening supply-demand imbalance. In the Pacific Basin, LNG demand is expected to almost double by 2040, according to Wood Mackenzie. As a leading global independent LNG supplier, Santos is well positioned to benefit from this increasing demand. With our Japanese and Korean partners, we're investing significant capital in bringing new supply to market through Darwin LNG from our Barossa gas field. Gas remains a critical fuel for an orderly energy evolution, and therefore we must invest in new supply to maintain reliability and affordability of supply for customers over the decades ahead. Likewise, the forecast for oil demand shows a growing supply-demand imbalance. Projects such as Pikka will be required to meet the demand, and the dynamics of the market are supportive of investment in quality, low-cost projects. Diversity of supply sources rather than concentration in the Middle East, Africa and Russia is also important for global stability and supply security. Santos continues to view Australia, the US and PNG as critical energy producing nations for the world, underlining the importance of its investments in these regions. In summary, it was a solid first half. The business is strong and benefiting from a diverse portfolio of high quality assets. Santos is committed to achieving our net zero Scope 1 and 2 emissions target by 2040. We are confident that our disciplined approach to operating our business and allocating capital will deliver strong returns to shareholders over the long term. I'll now hand over to Anthea to provide a detailed review of our financial results.
Thanks, Kevin, and hello to everyone. Santos has delivered a strong set of financial results. We continue to see the benefit of our diversified portfolio and disciplined operating model, which is reflected in EBITDAX of $2.1 billion generated in the first half of 2023. This half we have delivered free cash flow from operations of $1.1 billion and maintained unit cost production within current guidance. Gearing is 21.9%, and we've delivered a 14% increase in the interim dividend of 8.7 US cents per share for unfranked. This is equivalent to a 25% of free cash flow from operations for the first half. The previously announced share buyback is now complete, and the board has decided not to announce any further buyback in conjunction with the interim cash dividend. We've maintained a strong focus on costs across our operational business. Consistent with our disciplined operating model, unit production costs decreased year on year to $7.62 per barrel of oil equivalent, within our guidance range of $7.25 to $7.75 per barrel of oil equivalent. We've had a strong operational focus on maintaining production at the Bayu-Undan field for as long as possible. Our ability to do this is a testament to the skills of our people in the field, and we're pleased that the asset has continued to deliver production into the second half of 2023 and will deliver at least one more LNG cargo before consideration of potential domestic gas supply opportunities. Including the cost of Bayu-Undan, production costs were $8.52 per barrel. We continue to seek efficiencies and cost savings to offset cost and supply chain pressures we're seeing and are maintaining 2023 guidance. Pleasingly, total nominal production costs are approximately 9% lower than the prior period, despite inflation pressure. Across our business, we're targeting a free cash flow break-even of less than $35 per barrel through the oil price cycle. Our diversified upstream gas and liquids portfolio includes strong LNG contracts, liquids and fixed price domestic gas contracts, and underpins a first half operating cash flow of $1.6 billion. The reduction in cash flow from the prior half has been driven primarily by a 26% reduction in the average realised oil price compared to the prior half, a 7% reduction in the realised LNG price, and a 13% reduction in production volumes. We have delivered strong free cash flow from operations of $1.1 billion. Product sales revenue, whilst down from the high prices we saw last year, is a strong $3 billion. EBITDAX of $2.1 billion translated into underlying earnings of just over $800 million. This table shows a snapshot of the half-year results outlining the strength across our upstream gas and liquids business and the contributions to EBITDAX and margins. It highlights our diversified and balanced portfolio of core assets with strong margins of 69% for the first half across our 5 core segments, in line with our previous corresponding period. Turning to CapEx, 2023 guidance for the base business is unchanged at $1.5 to $1.6 billion, primarily due to phasing of spend for the Barossa project. We're investing now for the future, and our committed major project investment is expected to deliver significant cash flows once they are online. With Barossa and Pikka producing at nameplate capacity, we expect to see additional after-tax cash flows around $1.1 billion to $1.7 billion per year, subject to oil and JKM prices. The disciplined investment we are making now will provide flexibility to deliver returns to shareholders, invest in the energy transition, and continue to provide low-cost and reliable energy the world requires. We are focused on delivering our major projects and returns to shareholders while maintaining a strong balance sheet and access to liquidity. Our total liquidity of more than $4 billion reflects the strength of our underlying balance sheet and business. Gearing remains within the 15 to 25% target range, and excluding operating leases, it was 18.2% at 30th of June 2023. There's no significant debt maturing until 2027, excluding PNG LNG, which is repaid using project cash flows. Our strong balance sheet and liquidity metrics are reflected in the stable investment grade ratings we have from all major rating agencies. Thank you, and I'll now hand back to Kevin.
Thank you, Anthea. As I said at the outset, our unrelenting focus on sticking to our strategy and implementing our disciplined low-cost operating model has delivered consistent results and kept the business resilient and performing strongly. We continue to generate strong free cash flows to maintain the strength of our balance sheet and to provide returns to shareholders. Thank you.